Welcome back to another video in our penny stock series. My name is Mr. M Trades, and in today's lesson, we'll be focusing on risk management and how to manage risk for penny stock trading. What is risk management and why is it important? Simply put, risk management is crucial for achieving consistent results and protecting your downside. It's a risky game. Statistics show that 95% of all traders fail. To give you some interesting facts, 80% of all day traders quit within first 2 years. Among all day traders, nearly 40% day trade for only 1 month. Within 3 years, only 13% continue to day trade, and after 5 years, only 7% remain. To make sure that we do not fall into the losing trader category, it is essential to implement proper risk management into our strategy. Without it, you're basically swimming without a life jacket. Proper risk management is crucial because it helps you execute on your plan, keeping potential losses within acceptable limits, effectively managing your risk. You not only protect your capital, but also improve your chances of consistent profitability. It's about playing the long game, ensuring you stay in the market long enough to capitalize on opportunities when they arise. But first things first, always have a plan. No plan equals no trade. You need to plan and understand your risk. In order to do that, we need to know a couple of things. Number one, what is your entry and why is it there? We need to know it. Simple as that. The second thing we need to know is where do we place our stop loss? And three, how do we size our position? There are golden rules of trading that we need to consider. To never open positions without knowing your initial risk, defining your profit and loss in your trades as multiples of your initial risk, limiting your losses to 1R, which is 1% rule, which I'll cover in a second, and making sure that your profits on average are bigger than your initial risk. So when we look at the risk reward ratio, it's a balance between the potential profit and the loss of a trade. We need to look at every trade as it's having a risk. Not every trade is worth it. Understanding this ratio helps you pick trades that can offer, bigger return on your money. By focusing on trades that have favorable risk reward ratios, you're targeting opportunities that can potentially maximize your gains and minimize your losses. And you need to start thinking in terms of risk and reward. If you risk $100 and you make 200, you have gained 2R. If you risk $100 and you lose $150, you have 1.5R loss. 1% rule. What is it all about? Let's go over an example where we're going to learn how to understand and knowing your risk and apply it. This is something that I apply in for my trading as well. Here we look at the example of portfolio of $10,000. If we take 1%, which is our risk of $10,000, we are looking at $100 of risk per trade. As we already covered, we always need to trade our plan. So in this example, we are looking at entry at $20 and our stop loss is at 19, which gives us our risk of $1. A simple calculation that we can make here is to take our 1% and divide it by the risk on this trade, which is $100 divided by $1 of risk equals 100. 100 represents the number of shares that we can buy for this particular trade. In that case, if trade is going against us, we will be limiting our risk to that 1%, which is $100 only. And this is the key because as traders, we will be taking losses, but taking, loss that you planned for and sticking to that plan is crucial. Let's look at the example of the recent trade on the ticker MULN. We had a breakout entry here at at 1167 entry. Okay. The stop loss here at the closest pivot low was at 1145, which gave us a 22 cents of risk, our R. So if we want to know what kind of position we can take on this particular trade. So based on the still example portfolio of 10K, we're looking at $100 divided by 22 cents of risk equals 454 shares that we would have purchased on this particular trade. If that trade goes against us, our risk is $100. However, on this particular trade, the price shot up here initially before the pullback to all the way up to 12.77. That gained a 110 from our entry, gaining us a 5R, right? So 5 times what we've risked, we've gained. And this is key to understand because now we up 5R, and even if the following 4 trades would be a losing trades, we still end up in green. And when we wrap our head around this concept and how we can manage our risk, let our winners run and manage our downside properly, it provides a winning recipe for us moving forward. In summary, plan to succeed. Always have well-defined trading plan that includes your entry point, stop loss level, and position size. Without a plan, you're essentially trading blind. Adhere to the golden rules of trading. Never open a position without knowing your initial risk. Define your profit and loss in terms of multiples of your risk and limit your losses to 1% of your capital. Understand the balance between potential profit and potential loss in each trade. Favor trader with favorable risk-reward ratios to maximize gains and minimize losses. And finally, implement the 1% rule to limit your risk per trade to only 1% of your capital. This allows you to protect your capital effectively and trade with a safety net in place. That's it for today's video. Make sure to like this and subscribe, and I'll see you in the next video.